So look, this week could get messy. We've got Nvidia earnings dropping Wednesday. The Fed's basically flying blind because of missing data. And oh yeah, banks just borrowed over $50 billion from the Fed's emergency backstop in a single day. That last part, most people missed it entirely. Now if you're short on time or, skeptical about listening to some random guy on the internet, here's what you need to know. The market's sitting at a technical cliff right now, and 3 things happening this week will decide whether we rally into year-end or get a sharp pullback. Nvidia's earnings, liquidity stress in the funding markets, and the Fed's December decision, all colliding at once. Stick around because I'm going to walk you through exactly what's happening in the plumbing of the financial system and how to position yourself for what comes next. And yeah, I'll try my best to make it less boring than my old corporate presentations. Hey everyone, DataCat here. For those who are new, I'm just an average former corporate analyst. Spent years crunching numbers inside a Fortune 50 company before I traded the cubicle and endless meetings for, well, this. Still getting used to talking to a camera instead of a conference room, but hey, at least now I can wear sweatpants. If this sounds useful, go ahead and hit that subscribe button. This channel's only about 4 months old, and honestly, every subscriber keeps me motivated to keep doing this instead of going back to spreadsheets. Alright, so let's start with the thing that should have been front page news but somehow got buried. Last week, the New York Fed had what reports are calling a secret emergency huddle with the big Wall Street banks. And right around that time, banks borrowed over $50 billion from something called the Standing Repo Facility in a single day. Then another $22 billion shortly after. Now, if you are new here or simply forget, you may wonder, what the MEO is a Standing Repo Facility? Fair question. Think of it as the Fed's emergency cash window. Banks can show up with treasury bonds and other high-quality collateral and swap them temporarily for cash. It's been around for some time, but here's the thing. It barely got used until now. $50 billion in one day is the highest since it launched. So why does this matter? Well, it's a sign that the financial system's plumbing, the boring stuff that makes sure money flows smoothly between banks every single day, is getting clogged. And the reason is something called quantitative tightening, or QT. Quick refresher. During the pandemic, the Fed printed trillions of dollars and bought bonds to flood the system with cash. QT is the opposite. They're draining that cash back out by letting bonds roll off their balance sheet. And we've been doing QT for a while now. The problem is, we're reaching the point where banks are running low on reserves, the cash they keep at the Fed. And when that happens, short-term funding rates start spiking. You're already seeing it. SOFR, which is the rate banks charge each other for overnight loans, has been touching its ceiling. That's a warning light. It means cash is getting tight and banks are scrambling. Now here comes the natural question. Is this 2008 all over again? I guess not. Currently speaking, this isn't a solvency crisis where banks are about to collapse. This is more like 2019 when the repo market seized up for a few days and the Fed had to step in. It's a liquidity issue. There's not enough cash sloshing around to keep the gears turning smoothly. But let's not forget, the Fed's supposed to end QT in December, which should help. The transition itself, though, that's when things can get bumpy. And if you're holding risk assets, stocks, crypto, whatever, you need to understand that when funding markets get stressed, everything can sell off fast. It's not about fundamentals at that point. It's about, I need cash now, so I'm selling whatever I can. Like imagine you're a cat who's been napping on a warm laptop all day and suddenly someone closes the lid. You're not in danger, but you're definitely scrambling to find a new spot. That's the market right now, looking for stable ground. Okay, so on top of the liquidity stuff, we've got another problem. The Fed has no idea what's actually happening in the economy right now. And I mean that literally. Because of the government shutdown, the longest one on record. October's inflation data, jobs data, retail sales, all of it, either delayed indefinitely or might never come out, because the White House said last week that October CPI might just be gone. Then we have the National Economic Council director walk that back a bit, saying maybe we'll get a partial jobs report, like the number of jobs added, but not the unemployment rate. It's a mess. And this matters because the Fed's entire decision-making process is built on data. They look at inflation, employment, GDP, consumer spending, all the hard numbers, and then decide whether to cut rates, hike rates, or hold steady. Right now they're flying blind. So let's talk about the CME FedWatch tool for a second, because this is where I got something wrong in my last video. I thought once the government reopened, the CPI data would just come out and we'd know the market direction more clearly. Turns out, nope. Some of this data is just lost. And the FedWatch tool, which tracks the probability of Fed rate cuts based on futures contracts, has gone from showing a 95% chance of a December cut a few weeks ago to about 50% now. Now here's the thing. Normally the FedWatch tool is super reliable. It's not just guessing, it's based on real money. Traders at banks, hedge funds, institutions with billions on the line are literally betting on what the Fed will do. And they're using hard data to make those bets. CPI, jobs reports, retail sales, Fed speeches, they plug it all into models and put their money where their mouth is. Historically, when FedWatch shows a probability above 70%, it's right about 85 to 90% of the time. But right now, I think the situation is a bit different. That 50% probability doesn't mean the Fed probably won't cut. It means we have no idea because we're missing the data. It's maximum uncertainty. It's a coin flip, not because the economy's on the edge, but because traders are blind. My take though, I still think the Fed cuts in December. Here's why. They've got other data sources, regional Fed surveys, consumer sentiment, financial conditions indices, real-time payment data from banks. October might not even matter that much. The Fed looks at trends over months, not single data points. September showed inflation cooling, unemployment steady. Powell's tone before the shutdown was leaning toward cuts, and politically, the Fed doesn't want to admit the shutdown paralyzed them. The real risk isn't whether they cut or not. It's that when they do decide, the market might violently disagree because everyone's been guessing. If they cut and it turns out inflation was worse than expected, data comes out later, stocks could sell off. Or the opposite, they don't cut, data shows they should have, and the market throws a tantrum. It's like being a cat trying to land on your feet in the dark. You'll probably be fine, but it's not going to be graceful. Alright, so Wednesday after the bell, Nvidia reports earnings. And I know, DataCat it's just one stock, except it's not. Nvidia's earnings are basically a macro event at this point. Why? Because Nvidia is the backbone of the AI build-out. Every hyperscaler, Amazon, Microsoft, Google, Meta, is spending tens of billions on AI infrastructure, and most of that money flows through Nvidia's chips. So when Nvidia reports, we're not just learning about one company, we're learning whether the AI spending boom is real, sustainable, or starting to crack. The street's expecting revenue around $54 to $55 billion. But what really matters is the guidance for Q4, the Blackwell chip ramp. That's their next-gen AI chip, margins, and any color on China exposure given the export restrictions. Oh, and CapEx visibility from the hyperscalers. Are they still spending like crazy, or are they starting to pull back? Options markets are pricing in a big move, like 7% move either way. And because Nvidia is such a huge weight in the Nasdaq and S&P, that move will drag the whole market with it. Now, just as we think the market is confusing enough, Warren Buffett's Berkshire Hathaway just disclosed a new position in Alphabet, or simply Google. And people are asking, wait, didn't Buffett warn about bubbles? How can he be buying into AI? If you've watched my last video, then you wouldn't be too surprised about it, because you can simply believe parts of AI are frothy like Michael Burry, and still own the durable cash generators. In essence, don't just look at EPS. Cross-check free cash flow and CapEx. If a company's earnings are growing but free cash flow is flat or shrinking, that's a red flag. But if you want to learn more, you can go check out my last video. Anyways, apparently Google is not some speculative AI startup. It's a cash machine with search, YouTube, and cloud. It's got heavy AI leverage, but it's trading at a lower multiple than other AI leaders. Buffett, or his lieutenants, are doing what they always do, buying high-quality businesses at sensible prices, even if parts of the theme are overheated. So yeah, you can be selective in AI. Own the companies with real moats and cash flow. But don't assume everything with AI in the pitch deck is a winner. Some of this is froth, some of it's real. Nvidia's report will help us figure out which is which. Alright, let's talk charts for a minute. The tech sector, or QQQ, is sitting right at a critical level. As of last Friday, QQ closed at $608.86. That's right on the Fibonacci retracement level, $607.37, which is a key technical decision point. It's caught between resistance at the 20-day EMA, around $615, and support at the 50-day SMA, around $605. Now, here's what's concerning. Momentum is fading fast. The RSI dropped from 65 to 46 in just 7 trading days. That's a sharp loss of steam. The MFI also fell from 76 to 45, which means money's flowing out. Selling pressure's building. Price got rejected below the 20-day EMA, which is the first short-term bearish signal after recent strength. And we saw a moderate volume spike while momentum indicators are declining. That usually means institutions are repositioning or hedging ahead of something. Now the long-term trend is still intact, so we're not in a bear market, but we're only 4.4% off all-time highs, and the next support zone is $605 to $599. If we break that, things could get ugly fast. And this technical setup matches the macro backdrop perfectly. The market's in wait-and-see mode ahead of Nvidia. The volume spike and momentum loss suggest traders are taking profits or hedging before the event. The missing CPI and PPI data plus the 50-50 Fed odds means nobody wants to commit either way. So we're just chopping between support and resistance. Here's how I see the scenarios playing out. Bearish case. Liquidity headlines get worse, Nvidia disappoints or gives a cautious guide, and we break below $605. From there, it's a fast flush toward $590, maybe lower. The story in the tape would be liquidity scare, over-owned AI, and Mag 7 de-risking. Bullish case. Fed communications frame the repo stuff as technical and precautionary, funding markets calm down, and Nvidia prints a strong beat with a confident 2026 AI capex guide. QQQ reclaims $615, then runs towards $625 to $630, maybe retesting the highs at $637. The liquidity issue gets spun as the Fed's on it, QT's ending soon, which is actually supportive. Base case, elevated volatility with a slight downside bias until Nvidia reports, and we see whether this liquidity thing settles or snowballs. QQQ probably chops between $599 and $615, with risk of a break lower if another negative headline hits. Personally, I'm leaning slightly bearish into Wednesday. Not because I think the sky's falling, but because the setup favors caution. Momentum's weak, liquidity's tight, and we're missing key data. If you're long, consider trimming or hedging. If you're on the sidelines, wait for clarity. Cats don't jump until they know where they're landing. Be a cat. So what do? Stay flexible. Don't overcommit either way until we get clarity. If you're long, consider hedging. If you're waiting to buy, be patient. And whatever you do, don't ignore the plumbing. Boring stuff like repo markets and Fed liquidity tools, that's what breaks rallies when nobody's looking. Anyway, that's it for this week. If you found this helpful, hit the like button, subscribe if you haven't already. I'm still figuring this whole YouTube thing out, 3-4 months in now, so any support helps. And yeah, I know I'm not the flashiest guy on the platform, but I promise I'm trying to give you real value, not hype. Alright, DataCat out, stay safe and stay sharp out there. I'll see you in the next one.